55.
Angie's List is now Angie, and it's easier than ever to get your projects done right. With Angie, you can connect with top pros and see ratings and reviews. And when you book and pay through Angie, you're covered by our happiness guarantee. Check out Angie.com today. Angie, and done.
Them Diamondbacks are mighty poisonous. We should get you to a doctor.
Real cattle herd don't need no doctor. Let's drive this herd.
It's okay to ask for help. Find a licensed therapist at BetterHelp.com.
You're in sales. Stop wasting time searching the web to find emails. PeopleSmart.com is the faster way to find emails and phone numbers for your business. Saving time means closing more deals. PeopleSmart.com. Start prospecting faster than ever today.
Down on the year, up on a session from New York City this morning. Good morning. The Thursday morning price action shapes up as follows. At 1% on the S&P, on the NASDAQ up by a little more than 1%, up by 1.22. The Russell of small caps up 0.9%. That's the opening bell. This, believe it or not, a bit of a snooze. Get to the bond market. That's where the action is. We come down 4 basis points on 10s. We're up by a similar amount on 2s through much of this morning. On 2s, we breached 120 briefly. This curve is flatter. And this dollar is so much stronger. Euro dollar with a break of 112 to 111.52, down by 0.8%. If you take the dollar index, heavily weighted towards the single currency, the euro, yes, I know. But still, that's the broader story. Dollar strength, bleeding through G10, bleeding through EM. The dollar index, the highest since July 2020. And even with that dollar strength, even with the prospect of higher interest rates from the Federal Reserve, we're looking at a crude market that's still rallying. $88 a barrel, up 1 full percentage point. You've got to go back to October 2014 for the last time we saw crude this high. Brent's through 90. That was a month before the Saudis started that market share war. Crude right now, 88.20. Let's get you a thought of PIMCO's Jerome Schneider and what he had to say on Chairman Powell in that news conference yesterday.
Clearly it panicked. The market was looking for a lot of comfort food yesterday, and it got a helping of nothing. And from that perspective, it became a little bit over angst with the fact that potential for rates is actually going much higher than the market had suggested. This playbook is actually old age, in terms of the sense that we continually see the market in rate hiking cycles overshoot the actual reality of where that rate hiking sequence comes. So from a practitioner's point of view, this is actually an opportunity to look at where rates are.
What is comfort food? And we've got a helping of nothing. Julian Emanuel, Bob Dole, Lisa Shallett. I want to come to you, Julian, because Ed Hyman and you and the team over at Evercore actually still have a pretty punchy outlook for GDP. And Julian, just walk me through how that stacks up with what you expect from this market, at least in the near term, through the first couple of quarters.
Sure. Well, if you look at the first quarter, Ed took his number down to 2%, but still sees scope for 4.5% on the full year. And I think a lot of that is driven, and I think this is where, you know, some of our optimism on the equity market is placed as well, is that if you assume that the virus becomes endemic at mid-year, the potential for perhaps even above those numbers, because you're bringing the rest of the world back online, as it were, exists. And furthermore, if we're right about the course of the virus, that actually sets up the potential for above trend growth, above consensus estimates into 2023 as well. And again, to us, that's a recipe for not only strong earnings growth, but also the potential, if you unclog the supply chain issues, for a little bit of inflation abatement within the bigger picture of higher inflation.
That's baked into the guidance of some of the corporations as well. In fact, we've seen it from the airlines repeatedly over the last few weeks. Southwest this morning, no different. Losses in January, losses in February, profits in March, and they hope the runway's clear from there through the rest of this year. Lisa Shallett, you and the team at Morgan Stanley, though, I think of the work of Mike Wilson over the weekend into this week, a little bit more concerned about not the inflation story or the policy response to it, but the slowdown out the other side. The weakness in growth at the back end of this year, Lisa, how profound, how pronounced do you think that will be?
Well, look, I think we are going to have to deal with it, sooner than the very end of the year. I mean, look, we just got these great Q4 GDP numbers, and while, Chair Powell yesterday, suggested his intent to look through the first quarter GDP numbers, which might be tainted by, Omicron. The reality is that, in all likelihood, we're going to see a sequential deceleration that's pretty profound from, the 6.9% that was just reported to something, as Julian said, closer to 2% or less. In Q1. And that means that your PMI numbers, your order to inventory numbers, all kinds of demand drivers are going to look very weak. And we know that the correlations between, PMI ratios and change in S&P 500 is pretty good. So we think that some of this slowing debate may happen sooner rather than later. And we need to get past that and get that into the numbers before, I think Mike Wilson and I and the rest of the team would get more bullish.
Bob Dole, are you waiting for the same thing?
So I'm going to agree with both sides. That is to say, slow down in the first quarter, probably more than people think. We're using 3.5 for the full year. We do think, back to Julian's points, we'll see some pickup in the back part of the year. There's still a lot of underlying strength. I'm encouraged by the big surprise on inventory build in the fourth quarter of last year, the number reported this morning. I hope that means we're starting to solve some of the supply shortage problems. Time will tell. That's a big element along with COVID, but there's a lot of momentum still in the system.
5 minutes into this, we are positive on the S&P by 1 full percentage point. Top of the pile, energy by 1.9%. Bottom of the pile, underperforming relatively speaking, but still positive. Consumer discretionary up by about 1/3 of 1%. Every industry group on my screen right now in positive territory. On some of the price action, let's get to Abby. Hey, Abby.
Hey, John. Well, as you were mentioning earlier, probably one of the biggest beneficiaries from a hawkish Fed, that dollar, the Bloomberg Dollar Index, now up for a fourth day in a row, the most going back to September. And as you mentioned, the DXY, that dollar index, the highest since July of 2020. And the fact that you had the dollar higher into yesterday's meeting suggests that perhaps the dollar was anticipating the massive move up yesterday, that backup in yields that we saw, that 2-year yield yesterday up an extraordinary 13 basis points. In fact, if we put the dollar next to the 2-year yield, we'll see both are going in the same direction. But more recently, the dollar, as it climbs back toward the top of a trend channel, absolutely being helped out by that backup in 2-year yields, supporting the dollar. Not surprisingly, as cheap money comes out of the system and the cost of capital is potentially going to go up this year, that is not helping growth, down about 13%. Value outperforming, still down on the year, but down a lot less than growth. Today, John, it's a pretty even race, though. Both are higher, as you might expect with these bullish markets, but it is actually growth in the lead just a bit at this point, John.
Abby, thank you. Let's turn to Tesla. That stock is down by more than 3%, raising concerns over persistent supply chain constraints. Dan Ives over at Wedbush said this: with the chip shortage still a major overhang, these delivery numbers combined with this impressive earnings beat speaks to an EV demand trajectory that looks quite robust for Tesla, with clear momentum heading through 22. On the West Coast, Bloomberg's Ed Ludlow joins us now with more. Hey, Ed.
Good morning, John. On Dan Ives' point, right, it's a case of money left on the table. They said that for several quarters, production output at Shanghai and Fremont had been depressed because of supply chain crunches, right? Impressive beat on the top and bottom line, but we know in this earnings season that's not enough. What we want is outlook. And they said, yes, we'll grow an annualized rate of 50% this year, just like they said last year, but no specific numbers on how that growth comes from Berlin and Austin, for example. Then we think about future and supply chain. Come with me into the Bloomberg terminal and let's look at margins. Think about margins for a second. Zach Kirkhorn, the CFO, says inflation is a headwind. Rising commodity prices are a headwind. You bring 2 new factories online when your best factories that are already online have depressed volumes. That mix of profitable and less profitable vehicles changes, and then what happens to margins? MODL Go on the terminal will show you decelerating margin growth throughout this year. But don't worry, John, because in the long term, Elon Musk says this is all about full self-driving. In fact, John, this year is the year that full self-driving becomes real. And in the long term, they really put a lot of credence, I guess, on software being the big driver of profitability. I want to ask you this question, John. Where do we go on the stock? The price target, average 12-month price target is 950. We're at around 930 now. There's not much room to go. This is a stock that trades at 85 times forward earnings. We know where we stand now with the Fed and the outlook for rates. Is this an attractive stock when we think about valuations? And then we think about Apple, right? Apple's up 15% since an October 4 low. How high is the bar for earnings today? We know supply chain is going to be the focus after Tesla and because Apple's reporting from a key holiday season. How high is that buy and how strong does the outlook have to be from the lessons we've learned from Tesla?
Ed, thank you, buddy. I'm going to pick up on that question and go straight to Julian Emanuel. And Julian, I won't be flippant about this, and I don't mean to be snarky. I just wonder whether these earnings actually matter. Given the backdrop right now, given the focus on rates, the Federal Reserve, and ultimately just a broad de-rating of this market through much of this year. Julian, what say you?
No, they do matter, but what's different about this earnings season is that the commentary around margins in particular and supply chain disruptions is very, very much the focus. So if you're going to say that you expect these things to resolve themselves, or in fact, if you have companies that have said that we understand we are in a position to navigate and benefit in terms of margins from this higher inflation environment, and we've got the supply chain under control, those stocks still do okay. But the punishment for those that have margin issues or talk about supply chain issues is disproportionate in a higher volatility environment.
I just got this table from Alan Ruskin over at Deutsche Bank, and it has two columns through it. And I wish I could share it with you all, but it just dropped into my inbox. And on the one side, it has what the equity bears are saying. And on the other side, it says what the equity bulls are saying about the same situation. He's called it a titanic battle. At the top, it says, don't fight the Fed as they take away the punch bowl, the bears. The bulls say the punch bowl has plenty of punch left. Real rates are low, money supply strong. QE taper tantrum is here, plus QT fears are warranted. The equity bears, the equity bulls, accelerated rate hiking expectations are already priced in. And you mentioned margins, so let's talk about margins. The bears would say the firms are facing raw material and labor cost pressures. Margins peaked in Q1 21. The bulls would say firms have pricing power, strong margin will hold in. Bob Dole, on that last point on margins, which side are you on?
I'm on the nervous side. I am amazed how strong margins stayed as cost pressures came into the picture. We saw in the third quarter earnings releases how companies were able to pass most of those on. I think that gig's run out of time.
What about you, Lisa?
Yeah, we're with Bob on this. You know, our sense is that we are going to start seeing, you know, companies have to guide and one of the guide down on margins and talk about the cost pressures that they're seeing. And I think the biggest piece of that's going to be labor. You know, no matter who you are, whether, you know, you're a mega cap tech company or, you know, you're you know, a smaller mid cap company. In a distribution channel, the issues around wage inflation, I think, are real. We're seeing it in every industry, and I think that's going to be one of the talking points as corporate managements have to you know, revise guidance.
Bob Dole, I want to build on what Lisa's talking about. And Lisa, I apologise for jumping in right at the end there. But as I listen to Lisa and as I listen to Bob, Lisa, I'm really familiar with your thoughts and the research you've done together with the team at Morgan Stanley. But we don't catch up quite as often, and I wish we could. I can't think of the last time I heard you this bearish, Bob. When was the last time you were this bearish on this market?
Oh, it goes back some time. We came into the year with a target of 4,500. The consensus said the market's going to go up with earnings. Not everybody, but that was the vast majority. And our view is earnings will be okay, and maybe they're going to be a little less than okay now. The problem is derating. When you have inflation at 7, consumer price index trailing, rather than 2, and you have the Fed at the very beginning of a rate rise cycle, you can't expect PEs to stay at 22, which is where they were. So I think it's going to be a very volatile year in both directions. I don't think it's straight down. 4,500 is our target for year end, which is you know, down for the year, but up a little bit from where we are.
Julian, what are they getting wrong, in your mind?
Well, I'll go back to Chair Powell yesterday, and I would just say this, is that if there's any let-up whatsoever in the margin issues, in the labor issues, and Chair Powell's fondest wish when he went to sleep last night was that the participation rate would rise, and I think you can make an argument that at some point this year, again, going back to the virus, that it will rise. That to us sort of signals the potential for this continued growth with, albeit somewhat, still elevated, but diminished inflation concerns. And we think ultimately earnings will power the market higher.
Lisa Shallett, I've got 20 seconds left. It's all yours. Final word.
I would just say, we're in a place where it's, quote unquote, be careful out there. I'll end where I started, which is the Fed is walking a really thin tightrope here, and there's not a lot of margin for error.
Lisa Shallett, Bob Dole, Julian Emanuel, fantastic panel, guys. Thank you so much. Coming up on this program, the West united on Ukraine, with the US and UK coming together over sanctions should Russia invade.
We are working on a wide-ranging, deep package of sanctions going further than was done in 2014 over Crimea, and everybody is on the same page in the sense that President Putin risks very severe sanctions if he goes into Ukraine.
That is next. This is Bloomberg.
This is Bloomberg's The Open. I'm Rishika Gupta, live in the principal room. Coming up, Gary Kelly, the Southwest Airlines Chairman and CEO. That's at 10:30 a.m. Eastern. This is Bloomberg.
We're open to dialogue. We prefer diplomacy. It remains up to Russia to decide how to respond. We're ready either way.
The United States continuing to urge Americans to leave Ukraine amid Russia tensions, with the embassy in Kiev writing in a statement the following: the security situation in Ukraine continues to be unpredictable due to the increased threat of Russian military action and can deteriorate with little notice. Joining us now, From Brussels, here's Bloomberg's Maria Tadeo, and Anne-Marie is down in D.C. Maria, good morning and good afternoon to you. What's the latest?
Well, here's the thing. You talk about that risk of any war or military conflict breaking out at any moment. That is something the United States has said for weeks now. But I do want to say they are talking again, and that's been good enough for the ruble this morning. If you see it, it's ticked up a little. Now, just to give you some context here, Jonathan, the United States and NATO has now, or they have together jointly sent to NATO letters that would explain, that would address some of the security concerns that Russia may have. Remember, they said that they were open to pulling back some of the military equipment that could be problematic for Russia if they also pulled back some of the troops from eastern Ukraine. Now, the Russians have said that President Vladimir Putin has now read the documents, that he will take time in fully responding, but they continue to say for the time being, a war with Ukraine is something that's, quote, unthinkable for Russia. Whether or not you believe that that is the next move for the Russians, it is giving the ruble a prop this morning, this idea that the situation continues to be tense, but nonetheless they continue to engage diplomatically.
Anne-Marie, how viable is the off-ramp?
Well, that's a big question, right? Will President Vladimir Putin take this off-ramp? They're not saying completely no to the proposals. What they're saying is it doesn't meet their primary security demands. Potentially there is going to be some discussions on the secondary security demands, whether it's military exercises where placement of missiles are. This could potentially be a moment for President Vladimir Putin to sell to the Russian people that he was able to get something out of the West, given the aggression he has right now in terms of 100,000 troops on the Ukraine border and these military exercises planned in Belarus.
AMH, just looking at the administration right now, stunning the GDP figures. Just to move on quickly to that statement from the White House, I'll read out the first paragraph. The GDP numbers for my first year show that we are finally building an American economy for the 21st century with the fastest economic growth in nearly 4 decades, along with the greatest year of job growth in American history. Of course, some of this is just the dynamic of coming out of COVID, coming out of the pandemic and the massive downturn in the year before. But AMH, can we get this back at the epicenter of the conversation for this administration?
They're trying. You see that every day. Yesterday, the president met with executives to talk about Build Back Better. At the same time, what is overshadowing the questions the press are asking to the president, and also just the time his administration is spending, is these negotiations with Western leaders about what the sanctions package is going to be to President Vladimir Putin. As I continuously say, this just takes the oxygen out of the White House, and it is a pivot. The other thing we should note, Jonathan, is that Washington is going to be completely focused on who the next Supreme Court justice is. But for the Democrats in this administration, that is certainly going to be a win, because they're going to be able to appoint someone, and this is where the president could potentially cement a little bit of his legacy.
Maria, Anne-Marie, thank you to both of you from Brussels and from D.C. I keep coming back to that crude price. WTI, $88 a barrel. Brent right now, just short of 91. Had a little look at that a bit earlier, but there we are, 90.68, up by 0.8% on both WTI and on Brent crude. Your equity market's doing okay, better than okay, at 1.7% with a sector price action. Here's Kriti Gupta.
Well, good morning, John. You were just mentioning that oil price. Well, it's seeping into the stock market, too. Energy is going to be your leading sector, followed by materials when it comes to a sector basis, but a fairly broad rally, which is to be expected when you have about 3 to 4 weeks of some pretty intense selling. I want to point your attention to the fact that information technology is all the way towards the top of the leaderboard as well. What's important to keep in mind here is that a lot of this is coming from the semiconductor space in particular. If big tech moves are pretty strong, well, semis are even more magnified. Remember, in the last couple of weeks, semis actually kind of moved lower before the broader market did, and a lot of those losses kind of foreshadowed what was coming in the major index. One of the big things to keep in mind here is that it's also kind of coming back after hitting a 19%, just near the 20% bear market. It's now coming back after bouncing off of its 14-day RSI, essentially saying it's oversold, John.
Kriti, thank you. Just distracted by the bond market right now. Got some curve flattening through this morning. A lot of that was led by the move at the front end. We had a push through 120. A lot of that now is led by the move at the long end. We come down 6 basis points on 10s. This curve is getting really bunched up. 2s out to 10s. If we look at 7s, and we have a 7-year auction a little bit later today, 7 years versus 10s, there's just a couple of basis points in it now. So we're getting really, really tight, getting much, much flatter. 2s out to 10s now. The distance between the two, 64 basis points. That's one thing in a trading diary. I'll get to the rest of it going into the weekend. From New York, this is Bloomberg.
and get started today.
25 minutes in, equities trimming the year-to-date loss on the S&P. We're positive by 1.6, taking a little bite out of the monster loss year-to-date so far for the NASDAQ. We're positive there, 1.5%. That doesn't get my attention. I know there's a lot going on in the equity market, but the thing that gets my attention right now is in the bond market. 2s, 10s and 30s, and just the amount of compression we're getting, some real flatness through the curve. Led now by the move in 10s, we're down 7 basis points there. On 30s, we're down by 8. 180, a break of that on 10s, a break of 120 at the front end. A little bit early this morning, but we give some of that up now, up by only a basis point to 116.20 or so. That's the price action. Let's get to the trading diary. Your Treasury auction, the 7-year note, 1 p.m. Eastern. Apple earnings after the closing bell. The employment cost index, that comes tomorrow. Look out for that. The ISM manufacturing numbers on Monday, an ADP report later in the week. Then the big one is payrolls Friday, just around the corner. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Consider municipal bonds from Henyon & Walsh. If you have at least $10,000 to invest, call and talk with one of our bond specialists at 1-800-279-5279. We'll send you our exclusive bond guide, free, with details about how bonds can be an important part of your portfolio. Henyon & Walsh has specialized in fixed income and growth solutions for 30 years and offers high-quality municipal bonds from across the country. They provide the potential for regular income, are federally tax-free, and have historically low risk. Call today to request your free bond guide. 1-800-279-5279. That's 1-800-279-5279.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Thursday, January 27th. Here are the top market stories we are following for you at this hour. Hiking hike bets. Traders put the odds on 5 Fed rate increases this year after Chairman Powell's hawkish press conference. The short end sells off, the long end's bid, and the yield curve hits its flattest since November 2020. Swings and misses. Equities are on the front foot for now after 3 days of wild moves and a volatile future session. Tesla and Intel dropping after earnings as investors wait for results from Apple post-market. And cloudy skies. Southwest Airlines no longer sees a profitable first quarter as the Omicron variant delays the demand rebound and costs rise. We'll speak with the company's CEO, Gary Kelly, this hour. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, what a week it's been, and it's only Thursday. It is not over yet. The focus today, more so on the bond market.
Yeah, you look at that curve flattening, absolutely incredible to see what is happening here. You wonder what signal we should ultimately take away from that. It was interesting to hear Powell push back on the idea that balance sheet runoff would be designed to maybe steepen the curve. That wasn't his intention. So that's interesting from a bond market perspective. Maybe that's the reason why we're seeing the flattening today. Let's talk a little bit about the data that is folding into all of this. Of course, we've got a lot of data coming through today. Let's finish it off with the pending home sales numbers that are hitting the tape right now. On the Bloomberg, worse than anticipated. Negative 3.8 is where we are. Last time, negative 2.2. This is the month-on-month number. The market was expecting things to flatten out a little bit, but that certainly has not happened. On a non-seasonally adjusted basis year on year, negative 6.6. So that piece of data coming through a little bit softer than maybe the market was anticipating, economists were anticipating, but it's been such a hot space. The housing market is certainly an area for focus to focus on right now when we think about what is happening with the Fed. So let's talk about the Fed, Katie. Let's figure out kind of where we were, where we are, and where we're ultimately going. Where we were was 2 to 3, then we got to 4. I'm talking hikes here. Now we're pricing in 5. Is that too much? Are we going to see maybe the Fed front-loading and being a little bit more cautious further down the road? So here's our question of the day. Are investors still underpricing the Fed? Maybe I should add to that. Are we overpricing the Fed? Let's bring in Bloomberg's Mike McKee, Bloomberg's international economics and policy correspondent, and Ira Jersey, chief U.S. rate strategist for Bloomberg Intelligence. Ira, let me start with you. We saw a shift last night. We've gone from 2 to 3 to 4. Now we're at 5. Are we overpricing the Fed?
I think we probably are a little bit. Certainly the risk is that the Fed's going to go a little bit faster. But I think that we really, from my reading of what Chair Powell said yesterday, he didn't get that much more hawkish than what we were expecting him to say prior to the meeting. But maybe we were not guessing what the market was thinking quite properly. And I think what the market maybe is underappreciating is how much the balance sheet might be able to replace hikes. So even though, Jay Powell basically pushed back on that, he mentioned importantly, I think, that both balance sheet policy and Fed and hikes and interest rate moves in general would be the primary policy tools that they have to use going forward. So I think that the market, hearing that, primary policy tool being the rate hikes, that's the reason why we started to price for a few more. Interestingly, though, for the market, and you noticed how much flattening is going on, we're basically saying that they're going to make a policy mistake if they go 5 times. And that's what the market is telling you right now, with the long end rallying as much as it is and the short end kind of holding up pretty well.
Yeah, down 7 basis points on the 10-year, down 8.5 on the 30-year. Mike, to pick it up on Ira's point, was Chairman Powell as hawkish to you yesterday as the market is interpreting him as?
He wasn't as hawkish to me. I think I would agree with Ira, but he was, and this is the word Ira used, expectations. He was more hawkish than perhaps the market had expected. And that's where we are right now. It's all about expectations. Remember, all of these moves you're talking about in the markets come after the Fed has done absolutely nothing. They have just talked about what they may do in the future, and the Fed chair said they are going to be data dependent. They're going to watch what happens in the economy. So I think anything that you really price in at this point is going to be just a guess. We are seeing some signs that maybe things get a little bit better with Omicron fading, and also the inventory build in the fourth quarter could mean that supply chains are going to be a little bit better shape. So I'm not saying those things are going to happen, but they are reasons why it's too dangerous to go out on a limb right now and say, here's what the Fed's going to do in 2022.
Yeah, they're going to be nimble and they're going to be humble. Two words that really stood out from the press conference. Ira, let's just talk a little bit about what we know and what we don't know, particularly when it comes to balance sheet runoff. I think a lot of people were surprised that we saw yesterday the principles for reducing the size of the Federal Reserve's balance sheet, the notes we got around that. But nevertheless, we're still scratching around trying to understand exactly when that's going to happen. Does that bring it forward to May in terms of the runoff starting? What kind of size and clip we're going to be moving at? What is your assessment of what that process is going to look like? Because you talk about it maybe being a counterbalance to what is happening with the hikes, but we don't know how the process is going to unfold yet.
Yeah, I think that's right, and that's one reason why maybe the minutes might give us a little bit more answers as to what are there 2 or 3 different ways that the Fed might be thinking about conducting runoff. So I think if the Fed does hike 5 times, that what they'll probably do is, they're not going to go every meeting, and I think it would be very advantageous to them to skip May from actually hiking, because if they hike in March and then they hike in May, then the market's going to say, oh, they're going to go every meeting this year. They've already done it, and we start to price maybe for a more aggressive Fed than they would want. So pausing in May and then announcing runoff at that time, maybe starting small and then getting bigger, similar to what they did during the last time in 2017 when they started runoff, is possibly the way that they'll do things, and I think the way that they probably should do things if they don't want the market to kind of basically tighten too much for them. In terms of the new information that we did get, because that was part of your initial question, was we did get that they do want to still stick to a Treasury-only portfolio over time. So that means they might actually do mortgage runoff a little bit more aggressively than we were anticipating. We thought that they would run off the balance sheet pretty much at the same pace that they were buying in terms of percentages between mortgages and Treasuries, but maybe they're going to do a little more Treasuries than, a little bit more mortgage-backed securities than Treasuries. So that doesn't bode well for mortgage spreads in the mortgage-backed securities market.
All right, Mike McKee, I want to stop the focus on the bond market for just a second and talk about the equity market, because that is where the crazy action has been over the last week or so. Did Chairman Powell basically say in not so many words yesterday that they aren't paying attention to what's happening in equities, that just matters less right now?
Oh, it matters much less than people think. We got used to, or equity traders got used to the Fed paying very close attention to what they do. And the 2018 sort of tantrum at the end of the year when the Fed was raising rates and markets thought they should stop, that informed a lot of people's beliefs in where the Fed might go with this. But that was a different time, as Jay Powell said. The economy was a lot weaker then. It wasn't growing as fast as it is now. The Fed's view is that if you lose money, that's your problem. If you can't trade, that's our problem. And they're going to keep an eye on the mechanics of the markets and making sure things are all right, unless we get such a rapid drop or such a big drop that it would curtail consumer spending. But at this point, there doesn't seem to be any sign in the market movements that we're in any risk of that.
Yeah, I think it's hard to know what disorderly looks like, but as somebody pointed out a little earlier on Bloomberg television, you'll know it when you see it. Mike, final question to you. Widening the lens out, going a little bit more global on this conversation, the market is priced in now, let's call it 20 bips. I think that's where we are right now, maybe 25 bips in terms of the ECB going this year. It's factored in another rate hike coming through from the Bank of England. Can we just kind of think about the mechanics of how that is going to work, particularly for the ECB? Is that just you have to price in more because you can't let the spread widen too much, and the market is basically saying that we are going to see a gravitational effect because the ECB will not be able to avoid the shadow of the Fed? Or should we think in kind of more realistic terms about these two entities being separate? I'm just wondering how the linkages are going to work as the Fed kind of takes off at this very aggressive pace.
Well, I think there will be a sort of gravitational effect, as you mentioned, but that's not going to be the primary thought for the governing council at the ECB. Probably they're in the same situation as the Fed in that growth is going to pick up there likely, both because the Omicron variant seems to be dying out, and they've also got, finally, the pandemic relief money going into those economies. And so if growth is picking up, then there is going to be a question about inflation, and inflation's already high there. Although Christine Lagarde was playing it down compared to the U.S., it's much higher than folks at the Bundesbank want to see, that's for sure. So there's going to be pressure on them, but remember, with negative rates, they've got a lot more room to move than the Fed. They can go up and still be very, very accommodating. Bank of England's got two problems. They've got the virus and they've got Brexit. So they're in a kind of a unique situation, but gravity will also have an effect there.
All right, Michael McKee, Bloomberg International Economics and Policy Correspondent, as well as Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence. Thank you both so much for joining us. And we do have some breaking news that we want to bring your attention to. SoftBank COO Marcelo Claure is in talks to leave after a pay clash. This is according to sources familiar with the matter who say he is still in negotiations on that departure. Again, he is expected to leave after a pay clash. Right now, SoftBank ADRs are down about 5.4% in early trading here in the U.S. But coming up, we'll get back to the bond market and that reaction to Chairman Powell yesterday. We'll talk to Mark Cabana, Bank of America Global Research Head of U.S. Rate Strategy, who's joining us next. This is Bloomberg.
Place for traders.
It's Thursday morning and the bond market is wide awake, pricing in 5 potential rate hikes from the Federal Reserve after that more hawkish press conference from Chairman Powell yesterday. And the end result is a bit into the long end. We're down about 6 basis points on the 10-year yield, while we're still seeing some selling pressure in the short end. 115 on the 2-year is where we sit. That leaves the yield curve at its flattest, going all the way back to November of 2020. Obviously, some dramatic repricing going on, but does it have further to go? That is our question of the day. Are investors still underpricing the Fed? To help us answer that, let's bring in Mark Cabana, Bank of America Global Research Head of U.S. Rate Strategy. Mark Cabana, what's your answer?
Our answer is that the rates market is likely to continue to price in more from the Fed. Look, we heard 2 important things from Powell yesterday. 1, that the Fed is humble. 2, that the Fed is nimble. The Fed is humble because their inflation forecasts have been wrong. The Fed is nimble because they need to be responsive to incoming economic information, and they still see risks to the high side on inflation. Therefore, if the rates market prices more from the Fed, is the Fed going to tell the market that it's wrong? No. We think that what's happening right now is that the front end is essentially pricing in as much, or it's going to continue to price in as much as it can until it sees a more negative response in broad financial conditions. Essentially, the front end of the rates curve is challenging the equity market to let it know how many hikes can you take this year. And right now we're pricing in 4.5, 5 hikes. We think that the rates market is going to probably keep challenging until you see 6 or maybe even 7 hikes priced this year. And the rates market is essentially testing financial conditions for the Fed. And if financial conditions are okay, and if the rates market gives the Fed a path to hike 6 or 7 times this year, the Fed's going to take it. At least they're not going to tell the market that it's wrong. At least not yet. Powell's humble. He's nimble. And if the rates market gives it to the Fed, they're going to take it. And by the way, that includes the risk of 50 basis points in March. Now, this is not our base case, but if the rates market challenges the Fed and pushes the market to price 50, and if financial conditions adjust to that expectation, the Fed will follow the rates market. Powell didn't take it off the table yesterday. You're not going to hear any Fed official do that. They're waiting to see what the rates market will do. And that's why we're telling clients, look, stay underweight the front end. Keep paying July FOMC OIS, December FOMC OIS. Heck, you might even try and challenge the Fed to 50 in March. But you want to stay underweight, and that just means that this curve is going to keep flattening. You're going to see the front end sell off, and you're going to see higher overall rates, especially at the front end of the curve.
Mark, there's a lot to unpack there, so let me just talk a little bit about the equity markets and figure out what is going to happen there. We are moving very quickly in the rates market in repricing what is going to come out of the Fed. You're talking about the potential for 50 basis points. The Fed is not going to like a disorderly downdraft in equities. You talk about the bond market testing equities. The difference in the rate of change is what I'm interested in here. If we keep going at this kind of pace in terms of the repricing, equity markets at some point are going to have to catch up and catch up aggressively. I say catch up, catch down aggressively. Do you think the Fed is going to be comfortable with that if it's at pace? It will be much more comfortable with it if it is a managed process that isn't disorderly.
Absolutely. You are exactly right. The Fed does not want to see disorderly markets. And if the front end of the rates curve challenges the equity market, and if the equity market responds very negatively, and you see large risk-off flows, then the front end of the rates curve will moderate in terms of what it's pricing. But we just think that the path of least resistance is for the rates market to test the equity market. We think that that process is happening as we speak, and we expect that it will continue to happen. Now, we think that equities should be not only focused on what is the magnitude of Fed hikes, how quickly do they raise rates, but also how far will the Fed go? And what you're seeing today in the bond market is that front-end rates are slightly higher, but back-end rates are lower. The rates market is essentially telling you that we don't think that the Fed is going to be able to raise rates by very much. 1.75, maybe 2%. That's what the market is signaling about its expectation for the terminal rate this cycle. And the equity market is probably looking at that and saying, okay, well, if rates don't rise more than 1.75 or 2%, are we comfortable with that? Are we comfortable if the Fed gets there faster or slower? But we think that, again, the equity market should be keeping an eye on the rates market, and it should be trying to determine how comfortable it is with this adjustment. My sense is that
when we're talking about the rates market and you talk about the curve continuing to flatten, the front end yields continuing to go higher, can you put some hard numbers around that too? What levels are you talking about?
So we've been recommending that clients pay December FOMC OIS. We think they should be targeting 5.5 hikes this year. That's going to result in about another 20 basis point sell-off, at least at that part of the curve. So look, twos we think can also sell off pretty easily, another 20 basis points along with it. Once you start to get the market price in 5.5, 6 hikes from the Fed, something like that, we think that things will probably stabilize quite a bit. But to us, the path of least resistance is still higher rates at the front end, and we're looking at sort of 20 basis points on twos.
Mark, what am I doing with tips? What am I doing with linkers? Do you think the inflation story starts to fade? Do you think the Fed gets a grip on it? Do I want to be selling that space after that big run up towards the back end of last year?
Yeah, so we've been recommending higher overall real rates really across the real rate curve. We also have been recommending a flatter 5s, 30s real rate curve because we do think that the Fed is going to be able to get a handle on the inflation narrative. Certainly, it seems like the limited rate increases that the market's pricing so far has had a pretty meaningful impact on financial conditions, or at least it's been effective at tightening financial conditions modestly. And as that occurs, we expect that the market will believe that, okay, well, if financial conditions are tightening, that probably means less consumption, less investment. That means that the Fed's going to be able to slow growth and therefore get a handle on inflation. Now, we like positioning for higher 5-year real rates in particular because we've seen such strong inflows to the TIPS market really over the last 12 months. And as the Fed changes the narrative on inflation, as they get a handle on inflation, we're going to see those inflows into the TIPS market slow and maybe become net negative. And we do believe that those inflows have been most impactful at the intermediate dated part of the TIPS market, really around the 5-year. So again, that's one of the reasons why we like a flatter 5s, 30s real rate curve as well.
Mark, it's always great to catch up. Interesting analysis on what is happening here. Mark Cabana, Bank of America Global Research Head of U.S. Rates Strategy. News out of Deutsche Bank. Remember, Deutsche Bank out with numbers today. Deutsche Bank elevating Ram Nayak to co-head of investment banking. Remember, we're coming to the end of Christian Savings' 3-year plan in terms of revitalizing Deutsche Bank. We're going to get more news in March in terms of the new plan. What are this new cast of management going to be able to do in terms of getting this business onto the next stage? Deutsche Bank over the last couple of days up by nearly 8%. What are we going to talk about next? Supply chain problems continuing to have an impact on Tesla. They're going for a narrow model lineup to try and deal with that. We're going to also learn from Apple a little bit later on whether it's got the same problem in the semi space. Details to follow. This is Bloomberg.
Earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
OurCrowd.com.
Tesla's trading down 5.5%. The company betting it can keep expanding sales without adding new models to its lineup. The idea there being that it can deal with the supply chain problems that it is facing right now. The question is, with no new models, with no new shiny objects on the horizon when it comes to cars, Is that going to be enough for investors? Well, the stock market's certainly marking the stock down today. Ed Ludlow joining us now from San Francisco. Ed, there was talk of software, there was talk of robots.
Right.
This is classic distraction.
Yeah, I think so. And there's a 1-2 punch on supply chain, right? Production volumes depressed at the Fremont, California, Shanghai, China plants. Those are the money makers. Profitable cars come from Shanghai. Austin and Berlin come online this year. Those are lower profit vehicles. Inflation, rising commodity cost headwinds. The CFO was pretty clear. Outlook for margins uncertain, that's under pressure. So what do? Look to the horizon. Software, full self-driving could come this year, will come this year, Elon Musk says, and then you get a robot down the line which is going to solve the labor shortages in the economy. That's the takeaway.
And of course, chip issues front and center for Tesla. They will be as well for Apple after the bell today, Ed. What's the main
Definitely.
expectation?
Yeah. If we learn something from Tesla, it's that supply chain will be front and center. And for Apple, that holiday quarter is always key, right? So we want to know, and they don't disclose shipments of iPhones or key products. We want to know not just if they beat on the top and bottom line, but the takeaway from this week, this earnings season, what is the outlook, not just for the current quarter, but for full year 22, and what are the headwinds, and what is driving consumer spending globally?
All right, we'll look out for that report after the bell. Apple right now up about 2% early on in the U.S. session. Bloomberg's Ed Ludlow, thank you so much. And make sure you're tuning in the next hour. We will be speaking more about chips with Intel CEO Pat Gelsinger. That's coming up around 11:30 a.m. in New York. 4:30 p.m. in London. And of course, while we're seeing Apple up today, we're seeing a lot of tech up today, Tesla being one exception. The NASDAQ 100 right now up a little more than 1%, but a lot of the action is in the bond market. Coming in on the long end, yield down about 5.5 basis points on the 10-year. The curve is at its flattest since November of 2020 as this market reprices its expectations for the Fed, possibly 5 hikes this year. This is Bloomberg.
Award-winning accounting and payroll software for American businesses. We want you to succeed.
With PatriotSoftware.com, accounting and payroll, keep your time and money.
Go to PatriotSoftware.com today.
We all have the strength to see what's possible. It's up to us to unlock it. Tonal, be your strongest.
This is Scribd, an app that gives me access to ebooks, audiobooks, podcasts, and more. With Scribd, I can get in my steps and countless pages. Scribd makes every moment a reading or listening moment. Go to Scribd.com and try it free for 30 days.
We're about an hour into the U.S. trading session on this Thursday following a crazy Monday, Tuesday, Wednesday. Bloomberg's Abigail Doolittle is here with a look at the intraday moves. Abigail, right now we're on the front foot. We'll see how long we hold that.
It will be interesting because we are off the highs. Take a look at the S&P 500 earlier. It had been up closer to 2%, now up 1%, but still a pretty good gain. However, the NASDAQ 100 truly off of its highs, up just 0.8%. And one drag on the market, if we take a look at the SOX, that chip index down 2.3%. The Golden Dragon China index, those China ADRs down 1.5%. So a bit of a mixed picture here. Investors still sorting out what it means around the Fed, this newly hawkish Fed, or perhaps it's more Fed Chair Jay Powell's tone that's a little bit surprising there, a little bit more tough love in the idea that they will be tightening. And here's the result on the 2-year yield. Take a look at this over the last 3 days. An incredible backup, 19 basis points really, now at 1.16, really a big move. That could certainly be weighing on tech overall, creating a little bit of this volatility. Banks, not surprisingly, doing well. Taking a look at some of the other tech movers, Apple up 1.8% ahead of earnings. The big question here is how much is growth going to slow for this year, this fiscal year? It's expected to slow to the low single digits. Last year had been very high. Amazon up 2%, but in a bear market going into the report. Tesla, of course, being punished on the supply chain issues, not giving an actual unit count. And then Intel also being punished, weighing on that SOX, down 7%. The earnings view for the first quarter, not great. Investors worried that they're spending too much on the turnaround. Now, of course, it's all about the yield curve. We've been watching the yield curve flatten since last year, and Kaylee and I were talking about it last week. This is an interesting long-term chart because it suggests that as the yield curve goes toward inversion, this actually gives stocks a last gasp rally. If you take a look at here in blue, the 210, and then in white, the S&P 500. These are the 90s into 2000. The yield curve inverted it in early 2000. We, of course, all know the story there. A similar deal into 2007. And then we, of course, had that brief inversion back in 2019. That created the bear market that we see here in 2020, but still up and away. There's still quite some time to a potential inversion. One question for the S&P 500. Technically, right now, in the near-term congestion guy, is it a bear pennant that could produce a big move lower, or is it a V-bottom? This may suggest a V-bottom, but very difficult. Just so many different factors to think about and for investors to really grapple with.
There are a lot of moving parts right now. We were talking about this earlier pre-show, just how much news flow there has been in January. Everybody having to adjust incredibly quickly. Hard to figure out what the signal in the noise actually is. Abigail, thank you very much indeed. Let's try and figure that out, though, right now. Gina Martin Adams of Bloomberg Intelligence joining us now. Gina, let's talk about stocks. Let's get into the weeds on stocks and try and figure out what is happening here, because we've got the rate story on one hand and we've got the results story on the other hand. In terms of what is going to be most important for equities over the next few days, is it rates or is it results?
I think it's most likely to be results because we're now officially past the Fed meeting. So we have a pretty good idea of where the Fed is headed, at least in the short term. I think the market might still be a bit uncertain with respect to what's going to happen with the balance sheet and quantitative tightening ultimately. But at least on the rates front, we can price for 4 or 5 interest rates. We know that the Fed is committed to interest rate increases over the course of 2022. And that was pretty close to what the market expected with respect to sort of the rates forecast. What the surprise will be is how fast can growth continue to come in, and also where will earnings end up for the fourth quarter, and importantly, where will companies guide us for 2022, because the upside for stocks really this year is going to be about growth. We know that the Fed is tightening. We know that valuations will come under pressure as a result of that process. But where will growth come in? Because this is the other side of the equation. If earnings growth can continue to press on and the S&P 500 produce 15 to 20% earnings growth this year, that's certainly a solid source of support for the stock market.
Well, Gina, obviously the earnings we're focusing on this week are predominantly technology names that have gotten beaten up so far this year. How do you differentiate where within tech is going to hold up better?
Yeah, I think you have to pay attention to duration this year. I do think that rates are a really big part of the equity market story. As much as I would love to lean on earnings growth entirely, you do have to pay attention to duration. And the companies with the highest duration in the S&P 500 do tend to be tech companies. They tend to be the mega cap tech companies. They tend to be software oriented as opposed to hardware oriented. So I do think you want to pay particular attention to duration at the same time as you pay attention to earnings. For the most part, our models are still suggesting that tech could be an area of risk, but beneath the headline for tech, there are still opportunities. For instance, IT services and some of the more defensive segments within tech still have pretty significant earnings growth prospects relative to the rest of the sector. We should see faster earnings growth for this space, as well as valuation discounts in comparison to the rest of the sector. So I think you have to do your homework a little bit within tech. It's no longer a story of really close correlation for all stocks within the space, sort of the rising tide lifting all boats there, but more a story of dispersion and opportunities beneath the headline.
Gina, one thing I'm certainly already noticing is that supply chain pain is still present and is going to continue to impact margins. Is that going to be the story here? Are you getting any hints that we are going to start to see that problem alleviating itself as we work our way through the year? How much confidence do CEOs have, do you think?
Yeah, probably not enough is the short answer. I think the market is definitely anxious to hear about supply chain eventually clearing. This was the same story that we had in the third quarter earnings season back in October. The market was quite disappointed by the fact that we weren't going to see supply chains clear in the fourth quarter, and that's what companies guided us to expect. That disappointment did create some disruption in that earnings season. We could be in for the very same thing this earnings season. It's early yet, but so far we have not heard a ton of great news about the supply chain risks clearing, really reflecting the Omicron wave, which we're still contending with and really popped up toward the end of the fourth quarter. I would certainly love to hear companies say that this is all clearing, but the segments that are most at risk of this are certainly tech as well as the consumer space. And so far, we're not hearing a ton of news. Will we? It's still a possibility, but so far we're not getting a whole lot.
Gina, I truly cannot believe today is only Thursday. This week feels like it has been at least 10 days long at this point because the action has just been so insane. Yeah. You get 3 days worth of price action in one intraday period. Do you have any reason to believe that this volatility is going to be more subdued going forward?
I would like to say so, but we're really it somewhat hinges on what happens with rates. I mean, the rates volatility accelerated before S&P 500 or stock market volatility, and I think that is the guide. If rates volatility remains high, we're not likely to escape that fact. In the stock market, we're probably going to continue to contend with a relatively rocky climate in 2022, particularly in comparison to what we've just been through. And what we're going through in 2021 was just a market that was nearly bulletproof, really confident in the outlook. And I think that we're going to really question some of our assumptions over the course of 2022, sort of question our outlook. There's a lot of uncertainty. Where will inflation land? Where is